In 2008, 465 banks collapsed, wiping out millions. But what's coming in 2026? That will make 2008 look like a practice run. The next bank collapse isn't some far-off possibility. It's already been set in motion. And if your money is parked in the wrong place, you need to hear this before it's too late. Now, I know you've heard the warnings before. I know you're tired of the doom and gloom, but this time is different. I'm going to show you why the 2026 collapse isn't just coming. It's already here. Most people still have no clue what's happening right under their noses. Why 2026? Why not sooner or later? The answer is chillingly simple. It's a perfect storm of three powerful factors, and when I reveal these, you'll understand why every billionaire, every hedge fund manager, and the most powerful investors are preparing in silence. Factor number one, the commercial real estate bomb. Right now, over $1.5 trillion in commercial real estate debt is coming due by 2026. And here's the thing. These loans were made when interest rates were next to nothing. Buildings were full, stores had customers. But now, everything has changed. Remote work decimated office spaces. E-commerce crushed retail. Property owners are facing a nightmare scenario. They need to refinance loans at sky-high rates, but the buildings are now worth half of what they were. And the banks? They're stuck, holding the bag. Take a look at this. An office building in San Francisco that was worth $300 million in 2019 just sold for $60 million, an 80% loss. This isn't an isolated incident. This is happening everywhere, in major cities like New York, Chicago, Los Angeles, and Houston. And who's holding the toxic debt? Local and regional banks. The big players like JP Morgan saw this coming and dumped their exposure. But the smaller banks, they're sinking fast. Factor number two, the hidden losses, the accounting trick. This is where things get really disturbing. Banks aren't required to report losses on their bond holdings until they actually sell them, so they can keep pretending everything is fine, when in reality, they're bleeding out. Here's the kicker. When interest rates started rising, the hundreds of billions of dollars in bonds that banks bought during the pandemic lost huge amounts of value. We're talking over $600 billion in unrealized losses sitting quietly on the books. This is money that's already gone, but the banks don't have to admit it yet. And here's where it gets worse. These losses are concentrated in the same regional banks that are drowning in bad commercial real estate loans. It's a double disaster. When the public finally realizes these banks are technically insolvent, the panic will hit fast. Factor number three, the derivatives time bomb. This is the threat that could make 2008 look like child's play. Right now, the derivatives market is estimated at over $600 trillion, 6 times the size of the global economy. These are bets on top of bets, tied to real estate and interest rates, the two things that are currently breaking. When commercial real estate starts failing, these contracts will begin to collapse, spreading contagion through the system like a virus. The government knows this is coming. The insiders are already selling their stock. So you cannot afford to wait. Here's the 7-step playbook to build your financial lifeboat right now. Step 1, the FDIC audit. Go through every single bank account you own today. The magic number is $250,000. That's your insurance limit. If you have a single penny over that amount in one bank, you are playing Russian roulette with your life savings. If you're over the limit, move that excess cash immediately. Don't wait for the news to tell you everything is fine. Step 2, the flight to safety, Treasuries. If you can't trust the regional banks, where do you go? Look at U.S. Treasury bills and Treasury money market funds. Unlike a regional bank in Iowa, these are backed by the full faith and credit of the U.S. government. If the government goes bust, your cash is worthless anyway. But until then, Treasuries are the safest shelter in the storm. Step 3, the hard asset, shield, gold and silver. Paper money relies on trust. Gold relies on physics. When banking systems crumble, physical assets are the only thing that matters. Aim for 10% to 20% of your portfolio in physical gold and silver. And I mean physical. Coins in your hand, not a paper ETF that promises to pay you later. If you can't hold it, you don't own it. Step 4, the digital hedge, Bitcoin. In 2008, we didn't have an alternative. Now we do. You don't need to bet the farm, but having a small allocation to Bitcoin offers you an asset that exists entirely outside the banking system. It is decentralized, unprintable, and acts as insurance against a total systemic failure. Step 5, the geography hedge. Don't keep all your eggs in the American basket. If the dollar and U.S. banks are the epicenter of the crisis, you need exposure elsewhere. Consider opening accounts in jurisdictions with stronger banking laws, places like Switzerland, Singapore, or Norway. Make your wealth harder to freeze and harder to lose. Step 6, the emergency cash stash. When a bank run happens, the first thing to break is the ATM network. Electronic payments will freeze. You need physical cash on hand, enough to cover at least 1 month of food and fuel. This isn't paranoia, it's basic preparedness for when the digital lights go out. Step 7, speed is your best friend. When the first headlines break about a bank in trouble, the window to act is measured in minutes, not days. We saw this with Silicon Valley Bank. The people who hesitated lost access to their funds. If you hear rumors, don't wait to verify them. Move your money first, ask questions later. It's better to be safe and wrong than right and broke. The 2026 crisis isn't a question of if, it's a question of when. The indicators are flashing red. The smart money has already moved. Now it's your turn. Build your lifeboat before the ship starts sinking. Subscribe to this channel to stay one step ahead of the collapse. I'll see you in the next video.